We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
When the FDA evaluates a new drug, they seek to minimize the chance of approving a drug that is not beneficial to people's health or causes bad side effects. In doing so, they increase the probability of failing to approve a drug that would improve people's health. This is the trade-off between minimizing type 1 and type 2 error. The same trade-off occurs when evaluating which exposures to include in your portfolio. You can minimize type 1 error by owning a couple of broad market index funds and never seeking further enhancements to your portfolio. Minimizing type 2 error, on the other hand, means setting a very low bar for implementing a new strategy. The tricky part is that minimizing one error leads to a higher chance of realizing the other. The key is to strike a good balance, but the thing I find fascinating about evidence-based investing is that people can look at the same data and come to completely different conclusions depending on their preference for minimizing type 1 or type 2 error. For me, I know that each additional strategy has a diminishing marginal benefit, and in addition, the costs for implementing additional exposures at the portfolio level, not just the fund level, will increase the uncertainty regarding the net benefit from inclusion. And it's for these reasons that I tend to be more concerned with implementing a bad idea than missing out on a good one. In other words, I prefer to minimize type 1 error. So what exactly does this mean? Let's take factor investing as an example. A factor is a characteristic or trait that explains portfolio returns. Implementing a factor investing strategy means targeting securities with characteristics that you would expect to generate different returns than you would earn from owning the entire market. For example, the value factor uses fundamental measures such as book value to find relatively cheap stocks to buy and relatively expensive stocks to short. Eugene Fama and Kenneth French first identified the value factor in 1992 as a dimension of return in their three-factor model, which also identified a premium for owning small companies versus large companies. Since the publication of the Fama-French three-factor model, there has been an explosion in the number of academics and practitioners seeking additional factors that explain portfolio return, with over 600 different factors now published in academic and practitioner literature. But most of these factors don't hold up to rigorous standards. And remember, I'm more concerned about implementing a bad idea than missing out on a good one. For me to consider a factor to include in a portfolio, there are a number of things I'm looking for. For starters, it must provide explanatory power to portfolio returns and have delivered a premium, which is really just a fancy word for higher returns. Additionally, a factor must hold across long periods of time in different economic regimes. I'd also like that it works across countries, regions, sectors, even asset classes. I'd also like it to apply with various definitions. For example, I mentioned the value premium and it using book value, but it would be nice if it also worked with earnings, cash flow, sales, enterprise value, EBITDA, etc. I also would like to see that a factor holds up not just on paper, but after considering actual implementation issues such as trading costs. And finally, I'm looking for something that's intuitive, something that has a logical risk-based or behavioral-based explanation for its premium and why it should continue to exist. What you're seeking to do with this framework is identify the drivers of expected returns that are unlikely to be the result of chance. But it doesn't mean you should include everything that meets these criteria for your portfolio. As I mentioned before, each additional exposure you add to a portfolio comes with a diminishing marginal benefit, which lowers the probability that the benefits will outweigh the costs. As a result, it's really important that you carefully weigh the expected net benefits versus the degree of uncertainty. The other consideration that I think a lot of practitioners fail to think about is investor behavior. You can build the best portfolio in the world on paper, but living with that portfolio is a different challenge. Whether we're talking about factor investing or the use of non-correlated assets such as alternatives, I believe it's important to think about the frequency and methods with which the portfolio is going to be monitored. The less frequently a portfolio is reviewed, the more likely the long-term strategies will be given the space to let financial theory play out. On the other hand, if a portfolio is being reviewed frequently, and maybe you think I'm talking about daily or weekly, but I really think reviewing a portfolio quarterly is a lot, then you're opening yourself up for more behavioral mistakes, whether those are cognitive or emotional errors. And because so many people check their portfolios on a quarterly basis, if not more frequently, that impacts the way I personally think about portfolio construction. Now, I'm spending time here on frequency. When I talk about method of review, I'm talking about where someone is monitoring the portfolio. For example, are they looking at it on their phone via the custodial app or on a statement, which really just shows a position's gains and losses that don't account for income? And both when you're looking on your custodial app or on a statement, these reporting methods can exclude any insight for how positions that are no longer held might have impacted overall portfolio performance. Or is someone looking at a statement from their advisor that typically incorporates more comprehensive portfolio level performance? And are they looking at money-weighted returns or internal rates of return? And if they're looking at both, will they know the difference? And finally, will someone with a deep understanding of the various holdings be present when the portfolio is being reviewed? Now, as you're hearing these things, as you might expect given my role, I'm thinking about the choice to add or not to add positions to a portfolio on behalf of others. But when it comes to making your own decisions, here are a few things to keep in mind when evaluating what to include in your portfolio. First, every potential change to your portfolio should start with a written hypothesis that can be tested using evidence. This helps protect ourselves from the tendency to seek out confirming information or be swayed by any particular narrative. Second, slow down the process. Real long-term investors shouldn't be in any hurry to include something in a portfolio. Don't be afraid to lay out a timeline that spans 12 to 24 months. If you truly have a multi-decade horizon, taking this time isn't going to penalize you. And if anything, you're going to end up uncovering more things you didn't think about initially. Third, understand how product methodology differs from the methodology in the underlying research. It's one thing to find research that you believe in. It's another thing to find a product that captures a given exposure in a way that aligns with the methodology from the research. And similarly, you ought to understand the weaknesses of the models and the underlying assumptions being made, because it's really easy to find a strategy that works in hindsight. Next, diversification and return benefits must always be considered in light of expenses and taxes. Extra fees can offset the benefits of otherwise attractive investments. Most published research focuses on the cost at the fund level, but it doesn't consider the portfolio level or unique end-user experience. Running simulations to evaluate trading costs and tax impact of including a new fund or exposure can help you better understand the true impact to your end user. But if you're doing this for yourself, it's really a matter of being honest with how you'll behave and understanding how taxes and expenses, again, not just at the fund level, but the overall portfolio level, might change. And finally, even though this may seem obvious, don't invest in something you couldn't live with for multiple decades. There isn't a strategy that always works, but most financial theory tends to play out in the long term. It's just that investors often find sitting through the day in and day out experience to be far more stressful in real life than it is in theory. As always, you can visit thelongterminvestor.com for show notes, free resources, and a place to submit questions. And if you haven't already, don't forget to subscribe to the show. I have a lot of exciting stuff on the horizon that I don't want you to miss. But until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.